Hi, this is John Camaranos. Welcome to a new edition of Capital Considered. 2026 is only a couple of weeks old, and I don't like to do a performance review after 2 weeks, but I think some trends are continuing that started in the middle of last year or towards the end of last year that are worth noticing, or they seem to be continuing into 2026. So, first up, let's look at a bunch of Russell indices. What are we looking at here? We're looking at 15 different indices, but if you look at the top few bars here. They show the microcap indices and the Russell 2000 indices are kind of all bunched at the top. The Russell 2000 index, if you'll remember, is the small cap index. It's US small cap stocks. So microcap and small cap stocks are leading the way this year by a lot. Top index here is the Russell Microcap Growth Index up 8.67% in only 2 weeks of trading. And then if you move your eyes towards the bottom, you'll see the worst index is the Russell Top 200 Growth Index. That's large cap growth stocks. That's the Magnificent Seven. That's large cap tech stocks. They're the worst of the bunch, down 1.01% for the year. And then just above that, down 0.56 is the Russell 1000 Growth Index. Also, large cap growth stocks, probably some mid caps thrown in there as well. But that's the general trend in the US stock market so far this year. Small caps doing really well, large caps not doing so well. And that's a change really for the last 3, 5, 10, and even 15 years. Going back to the financial crisis, large cap growth stocks have led the way almost that whole entire time. So remains to be seen if this shift will continue, but it is a noticeable shift at this point. So let's move on and look at the Magnificent Seven themselves. So this chart shows the seven Magnificent Seven stocks at the top, the seven big tech stocks or internet related stocks at the top. Five of the seven are in negative territory. Meta, which is Facebook, Apple, moving from top to bottom here. Meta, Apple, Microsoft, Tesla, and Nvidia are all negative. Granted, Nvidia negative, but not by much. And then Amazon and Alphabet are in positive territory for the year. If we equal weight them instead of the fancier way to do this is to cap weight them according to their expression in the index. We're just equal weighting them. So if you own an equal amount of these stocks, your aggregate performance in them is negative 1.56%, as the second bar from the bottom shows. And that equal weight index average is below the S&P 500, which is up 1.44% for the year. So the Magnificent Seven are not looking so magnificent this year. Let's move on now to broader markets and asset classes. Some of these are what you'd usually see in a lineup like this: US stocks, foreign stocks, and bonds. But I picked some random things that I thought were of note because they did very well last year. They're continuing to do well this year. At the top of this list, so first of all, this list is broken up into stock or equity indices at the top and three bond indices at the bottom. So at the very top, we've got the Wisdom Tree Europe Defense Fund. Uh, this fund went kind of crazy last year. It was opened in the middle of the year, so it doesn't have a full 1 year performance record, but it did very well because European defense stocks did extremely well last year, and they continued to do well as the U.S. And its relationship with NATO becomes more tense, and European countries think that they are more on their own. Seems they may be right about that, but European defense stocks are doing extremely well, up 17.07% in 2 weeks. Kind of an amazing return. Second bar here is the Russell 2000 US, the main US small cap index, up 7.92 for the year. Again, for a 2 week period, that's pretty amazing. Third is Japan, Japanese stocks up 6.68. This is in dollar terms, not in yen, translated back to the US dollar. Below that is emerging markets, up 5.78. And then I threw this fund in, the Cambria Global Value Fund. This is run by Meb Faber's firm. We had him on the podcast recently, Cambria Investments. This is a fund that ranks countries by the Shiller PE ratio, or the price to past 10-year average real earnings ratio. And so it's got a lot of small countries in this fund. I think at the top of the list are Colombia, Singapore, Poland, and the Czech Republic. Those are the top four. And the United Kingdom is fifth. So that tells you how cheap, at least on a Shiller PE basis, the United Kingdom is. And so this fund's up 5.39%, owning a lot of these really small countries that show up really cheap on the Shiller PE metric. Below that is REITs. That's kind of a surprise. They're up 4.6% for the year. REITs have had a very rough time over the last 3 and 5 year periods. So this is a big change for them. Office REITs, of course, hurt a lot. Apartment REITs have not done well lately because there's more supply there than there has been in the past, and the sector is now dominated by data centers and cell tower REITs. So it looks a little bit different than it used to, but certainly a change this year, up 4.6%. Below that is the world stock market minus the US, the MSCI ACWI, as we call it, ex-USA. So whole world minus the US is up 4.05% this year through Friday, January 16th. Below that, we come to another US index. This is the S&P 500, but it's equal weighted. So it's a really different version from what we'd call the normal S&P, or the cap weighted, the capitalization weighted S&P 500, which has all those tech companies occupying 25-30% of the index. This equal weights the components of the index and really underweights those stocks, really takes those big tech stocks down. And this index is doing well, 3.89% for the year. Below that is foreign developed countries. So that's Western Europe, Japan, and Australia mostly. That's up 3.45. And then we come to the plain or capitalization weighted S&P 500, which is up 1.44%. And the fact that this is behind the equal weighted index, which is 2 bars above it, shows that those big top tech stocks are not doing so well, or as well as the other stocks in the index, the smaller stocks, the less well-known stocks. Now we come to bonds, the 3 bottom bars. The Bloomberg Municipal Bond Index leading the way at 0.93%. That's kind of an astounding performance for municipal bonds for a 2-week period. Municipal bonds have not been doing well over the last few years, and now they've started to do well again, or so it seems. Below that, junk bonds up 5.56% for the year. It's a pretty good return, again, for a 2-week period. And then bringing up the rear is the main U.S. bond index, the Bloomberg U.S. Aggregate, which is up 0.01%. This is an intermediate term investment grade bond index. So U.S. Treasuries, mortgage-backed securities, and high quality corporate bonds, investment grade corporate bonds. So this is flat virtually for the year, up 0.01%, virtually flat. So that's how things stand after 2 weeks. Foreign stocks doing better than U.S. stocks. U.S. small caps doing better than U.S. large caps. European defense stocks kind of going crazy again. REITs a surprise. And the Magnificent Seven maybe a surprise to the downside. And we'll see if that trend continues. For now, this is John Comarianos and Capital Considered signing off. Thanks for watching. Please click like and subscribe.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.